Hi, everyone. Welcome to Wise Folks Almanac. And today in our show, we have Matthew Peterson. Hi, Matthew. How are you today?
Hi, Ahmed. It's very nice to be here. Thanks for having me on your program.
Great, Matthew. So before hitting the first question to you, I'd like to introduce you briefly to our audience. And for that, we have just prepared a note. So I'm going to read it out, actually. So Matthew Peterson is the managing partner of Peterson Capital Management, LLC, where he's managing the Peterson Investment Fund One since its inception over 10 years ago. Additionally, together with the Mesut Elieltioglu, Matthew launched his second fund in Turkiye, Talas Capital LLC. Before establishing both of these funds, he worked in various finance and risk management roles in prominent global firms such as Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, and Ameriprise Financial. An avid reader and follower of Warren and Shirley, Matthew holds a CFA designation as well, and now resides in Austin with his wife and their two children. So, Matthew, here goes my first question to you. So, you have been in the investment management business for a decade now, and you have grown Peterson Capital Management's AUM 20 times with sustainable market-beating returns. For the young audience listening to the show, could you please explain your investment philosophy of buying great businesses with great management at a great price? And most importantly, how do you define a great business? And what differentiates great management from the mediocre or the crooked ones?
Fantastic. Ahmed, thank you for the kind introduction and a very thoughtful question to kick us off. It's a pleasure to be here. And for a brief bit of background, again, as you mentioned, we've been running Peterson Capital Management now for about 11 years. And you mentioned this 20x growth, but that's a little bit exaggerated here because we've actually been raising capital and compounding capital. And so when we add those two together, the numbers look quite astronomical. But we have done quite well. We've been running the fund now for almost 11 years. And Peterson is a globally focused fund with a very concentrated long-term value-based approach. And then, as you mentioned, Talas was launched with Mesut Elieltioglu, just an incredible individual who I had the pleasure of meeting through Guy Spears Value X conference about 7 or 8 years ago.
Great.
Mesut has been focused on the Turkish equity markets for his entire career. So for about 25 years, he's been focused on the same couple hundred businesses. And those businesses he was the chief investment officer of ABN AMRO. He's been analyzing these companies, the managements, and the prices and the opportunities for decades. And so we are really privileged to have Mesut involved in the management of the Talas Capital business. So to address your question, Ahmed, a great question. There's a couple of things that I think your audience can benefit from. First is we have a very important framework, even before we get to the framework that you're discussing, which is the focus on our process. And I think a lot of folks in this industry are so focused on the outcome that they don't have the proper process in place. We focus on the process, not the outcome, because if the process is done properly with a positive MPV in terms of probabilistic outcome, the outcome will follow. So we're always trying to enhance our process. And our process is actually quite simple if you were to lay it out on paper. We start with a sort of 13F analysis, which you can do here in the United States. Every fund of size is required to file with the SEC each year, a snapshot of their portfolio, and actually each quarter. So every 90 days, we receive, and it's actually about 60-something business days.
Right.
We get to see the updated portfolio of prominent value fund managers, and it's particularly important in value because the turnover is so low. So we can see what Bill Ackman's doing. We can see what Charlie Munger or Warren Buffett are doing. We can just open the filing and see exactly what Guy Spear or Manish Prabrai have done recently. So this is quite interesting information. It allows us to really narrow down our focus to a basket of securities that are most likely to have the mispricing. So, these Nobel Prize winners for efficient market hypothesis, they're mostly right. The markets are usually efficient. So if you were to just look around the world, you'd spend a lifetime trying to find these mispriced opportunities. But through these 13F filings, they really lay it all out for you. And to that point, I want to emphasize that screening is something that people use commonly because it's simple, but it doesn't work. When you're screening, you're incorporating all sorts of information from the financial statements that can be somewhat misleading, and then you get misleading output. So you start with the wrong basket of securities. You're starting with the value traps. You're starting with the low PEs and no growth opportunities, and that's just the wrong place to begin. So we're very pleased that we have this 13F basket that we can start analyzing. From there, we do the financial analysis, and we try to understand, are these good business models? Are they poor business models? And from there, then we work out, our buy price and how we'd like to approach entering the security. So we do something very unique where we're writing puts as a tool to buy the stock. And through that method, we end up with prices that are below what exists in the market. So we can buy for less than a retail investor would pay, and even a professional investor in most cases. And in fact, we write covered calls if we want to exit after usually a series of many years. And we pick up premium on that end as well. So we get out and exit for above market prices. And that's a very clear advantage within our process. And then we focus on sort of portfolio construction. And portfolio construction is essential. You need to optimize your diversification. I think most people are far too diversified. In fact, we call it diversification. So people are, portfolios I look at regularly have introduced new, seemingly diversifying positions that will clearly perform with a lower return than sort of a higher conviction idea. So it's a pointless addition to a portfolio. It may or may not true diversification because correlations tend to move to 1 during a crisis, but it certainly introduces a lower return. So we focus, we sort of the guideline we use is Kelly criterion. It's a pretty nice way to look at how to concentrate a portfolio. And again, that also helps us educate us into what 13Fs we should look at. So a 13F that holds 30 positions is not of interest to us. A 13F that holds 8 positions with $1 billion under management is of clear interest because a new position is very high conviction for that manager. So with that, you ask a couple of important other questions, and they all come from even another perspective that I have. And it's that one thing we are looking for, but really we are excited to discover, is off financial statement value. What we want to find is the things that are missing from the financial statements, so all the screeners are looking the other direction. And that is what gives us oftentimes a mispriced opportunity. So if you have an outstanding business model and you have outstanding management, then the price tends to be outrageous. Okay. And if you're in that situation, it's not really value opportunity. It's not something that we're necessarily interested in. So to get a good value, to get a good, fair, even buy price, the herd mentality needs to be missing the opportunity. And so a lot of times that's something you can discover with off financial statement value. So where does that lead us? That leads us to understanding like what of these, if we're going to concentrate into 6, 7, 8 businesses that are really long-term, we're going to become owners of these firms. We can be extremely selective. So we're only going to focus on the very best business models. Now, we don't want every business model to be the exact same business model because we do want a little diversification, but we want just the very best. So those are business models where there are modes, where there's cash flow that's actually growing and increasing, where the model can introduce new products when past products are stale. There are businesses where the customer is getting more value for whatever activity, service, good is being purchased than they're paying. The perceived value is much higher. And they're businesses that are really win-win with the whole ecosystem. So we can't have a business that's pleasing customers but offending the regulators. We need to have everybody wanting this business to succeed and benefiting from the success of the business. That could be customers, suppliers. It can be the regulatory bodies. Everybody should be winning. And if you find a great business model like that, you can have a lot of tailwinds affiliated with that business. So there's great businesses in the SaaS space right now. So SaaS business, there's a lot of upfront investment that takes place to create an adequate product. But then if the price doesn't really recognize, if the market price doesn't reflect the investment that was made previously, you may have a very wide margin product that can persist for many years. And the costs, the incremental expense is going to be very low. Something like that is a very attractive business model to us. Things that are less attractive could be, we used to actually have some big metal stamping investments, and those are actually less attractive businesses. So like a OEM or an auto manufacturer has, through our own evolution, we've recognized that this business model is not very attractive because there's so much upfront expense and investment. And if you get the market wrong, the interest in whatever product or design, you can make a very big mistake. You can make a big investment without a lot of cash flow coming in. And with a low margin and high competition business, it becomes tricky. You want like monopolies, oligopolies. I mean, I'm sorry, a monopoly might not be a good word in business, but if you find yourself in a monopolistic situation, you're probably going to earn a whole lot of profit. Okay, so
absolutely.
These are the business models that are attracted to us. Now, the interesting thing is you can have a great business model and you could have terrible management. They could be corrupt. It could be, they're stealing. But usually I find that's not the case. It's that they sort of misinterpret the market and they're just making errors. And if you have management that's sort of moving in one direction and it's the wrong direction, that's a problem. So you get a great business model that's spinning off all this cash flow. And then management gets to determine what they do with that cash flow, right? They could buy back their stock. They could pay a dividend. They could pay off debt. They could start a new internal business. They could start acquiring other businesses. They're kind of these 5 big buckets. And if the value of the business is really undervalued, maybe they would benefit a lot from buying back shares. But instead, if the management's out there paying off debt and issuing a dividend, they could be perhaps destroying or not creating as much value. If they're out there making poorly timed acquisitions, they could be completely destroying the beautiful cash flow from the business model. So that's why you need this pairing of extraordinary, excellent management with the great business model, because the management is controlling the cash flow coming from the business. And so a lot of what you need, unfortunately, is a long track record to assess the quality of the business making decisions. And but I think if you look in the space long enough, you can start identifying the key players and you can identify the teams that move around. So we have sort of internally, we have all these maps of the boards of directors and the executives and where they've moved and who else they're affiliated with. And these directional situations can actually alert us to new opportunities. And
right.
If I give you a clear example from the Peterson portfolio, I've been following Berkshire for many decades, 2+ decades now. And so I've been following Berkshire, Warren Buffett and Charlie Munger. And about probably 12, 13 years ago, because of that, I became very interested in the West Coast situation that used to exist, and then ultimately Daily Journal. And I started attending the Daily Journal meetings back in about 2011. These meetings, Charlie Munger runs Daily Journal, but there were only maybe 1,000 people attending the meetings when I first went. So there would be 40,000 at Berkshire Hathaway and then be a room full of 1,000 at Daily Journal. And it just didn't make any sense because you have Charlie Munger standing there. You can ask him direct questions, even sit down and take a picture with him if you'd like. It's just not crowded. So by following, this is a very high level broad scope, but by following the management teams around, you can find these new opportunities. Now, Daily Journal ended up being, we now own 1% of Daily Journal. Daily Journal is a large position in our portfolio. And it's because we were following management around to the other companies that they're running. And we found that Daily Journal, despite looking like a newspaper business, which screeners would miss because it looks like newspapers are a poor business model today, it's actually a pseudo-SaaS business. And that's all hidden from public view. So it becomes quite attractive. So we're looking for these great management teams. A lot of times you can follow them from one business to another, even outside of the 13F pool. So Daily Journal was not in the 13F pool when we were looking at it. And now we look at Daily Journal to see what else should be in our 13F pool. So there's a lot of positive feedbacks that happen from approaching things this way. Finally, you mentioned, how do we determine the pricing and things? So we look at the greatest business models and we look at the greatest management teams, and we need to find a very fair price. So I touched on this before, but when you have these extraordinary businesses and managers, the price is usually astronomical. And so actually we need to wait for oftentimes times like now, times where the whole market is sort of falling a bit, things are coming down a little bit. When that happens, a lot of times these great companies that might not screen well start looking really attractive. And it's during troubling times when you can upgrade your quality of your portfolio. So you can take an existing attractive looking position and maybe just very quickly remove it from the portfolio and just step up in quality. And when things come back, you have a beautiful portfolio that's maybe you've got a very fair price or even a very inexpensive price for a wonderful business with excellent management. And you can hold on to those. They're like a Fisher compounder. You can hold on to those businesses for years, maybe decades without touching it. In fact, you should be holding on to those kind of businesses for years and decades without touching them. And so hopefully that answers some of those first questions. Happy to go on to more on any of those aspects.
Perfectly. And yes, as today's time might not permit it, but I'd like to expand a lot on those 13F and without 13F, how you are actually managing Turkiye business. So yeah, maybe we'll go into that. But since, we'd like to have, the questions covered that we have already planned. So maybe moving on to the next question, right, Riyan?
Thank you so much, Ahmed. And thank you, Matthew, for sharing your thoughts and philosophies with us. Many Bangladeshi high net worth individuals and families are actually buying assets in Turkiye, which is formerly known as Turkey these days. You are an expert when it comes to Turkish investments. And we will talk about your Turkiye-based investment firm, Talas Capital, in a moment. But why don't you tell our audience about how you're thinking and dealing with the macroeconomic conditions, including the currency volatility, the political regime, and does macro play any role in your investment decision?
It's a really good question, Riyan. Let me answer it completely this way. We have two funds. We have Peterson Capital Management and we have Talas, and both of them require a slightly different skill set and a different approach. So with Peterson Capital Management, we can take this perspective where we're analyzing 13Fs. We're looking very bottom up at businesses, same as Talas, but we're looking very bottom up at businesses. And in many cases, it is important to almost ignore the macro trends because the macro is so unpredictable. It doesn't give us much of an edge. And we get more of an edge focusing on an individual business, that business model, whether or not the margins will grow, the cash flows will grow, if it's going to be managed appropriately. And that's where we can identify an exceptional opportunity. Now, in the US and for the Peterson fund, we might have 10,000 securities available to us. So we need a 13F type solution to narrow down something, or we will just be in analysis paralysis. We can never understand every possible opportunity. Talas in Turkey is quite different, and it would be different in Bangladesh and a few other. Turkey only has maybe 400 public securities, and of those, about 200 are of no interest. And so you can actually analyze the entire market. And if Mesut Eliotolu has been doing exactly that for decades. And so it becomes, when you're in a developing and emerging market, you can actually just grasp and try to understand the entire marketplace. And it's just not possible in the US or a global world. So because of that, and also because of the nature of developing markets, we need to take the macro into a little bit more consideration because it can move the markets up and down by extreme measures. So we are still focused on bottom-up company-specific analysis, but we also need to be aware of what's happening in the marketplace. So let me give you an example of that. The current political environment is complex. When we're over in Turkey, right now I'm not in Turkey, but even we are constantly meeting with the management of these firms. People are very reluctant to speak openly about their views, but there's this idea that the current administration is following some very unorthodox economic policies. And what do I mean by that? I mean like rampant inflation, and then they lower interest rates, which everyone knows from Econ 101 would cause more inflation. So we all question these moves, and it creates volatility, unnecessary volatility, and a lot of uncertainty in the Turkish markets. What that does for a firm like Talas is create these strange opportunities where a really outstanding global firm might be traded on the Borsa exchange in Istanbul. And because of that, they'll see the price fall with everything else, but they might be earning dollars or euros or selling a commodity type product that's priced globally in, say, dollars or euros. Meanwhile, their expenses might be falling because they're operating in Turkey. So these things can actually help us moving into the positions, which is why we're sort of hyper aware of this. Let me touch on it and give you a conclusion to that statement, though. The current unorthodox economic policy in Turkey, we expect will end. There's an election coming up in March, and the situation is as follows. Currently, the whether or not they win or lose, everyone knows the economic policies have failed. Even the current administration, they just cannot admit that right now, or they will lock in their loss at the next election. So over the next, it's a very interesting time in Turkey because these elections are coming up. And we know that a new administration would change to more orthodox economic policy, and even the current administration would turn to more orthodox economic policy. So we expect the economic direction of Turkey to be improving greatly over the next, let's say, 1 year period of time. But because of the past, because of the recent past, 5-6 years, the prices are extraordinarily low because people are so uncomfortable with the unorthodox policy. So we've seen, and let me interrupt me if I'm going on too long, but I'll talk to macro one more moment.
Continue.
In Turkey, when we launched the firm, Talas, in 2017, I believe that lira to dollar was maybe 3 or 4 to 1. Today, it's approaching 18 to 1. Okay, so we have seen a massive decline in the lira, and we are in this fund. We analyze everything on a dollar-based term, so that it's clear to all of our partners, all of the limited partners within the fund, that we are not just basing our returns on a lira-based return, which is sort of hard to understand what that means in your local currency. So we do everything on a dollar-based return. So the Turkish market has gone through, in these sort of 5 years, currency crisis, major political crisis. We've gone through, this pandemic, and each of these things have caused massive collapses in the market. And this current Turkish stock market in dollar terms is over 50% off where it was when we launched. So it's more than 50% decline in the Turkish market since we launched. Our fund is flat, so in dollar terms, which is not impressive in absolute terms. I mean, we haven't made a whole lot of money right now, but this has not been trading. This has been ownership of great businesses and leaving them alone. And in fact, these businesses recently have started instituting major buyback policies with their cash flow. So they're buying back a lot of stock at the moment, and that's very attractive to us. So we began with them mispriced, and right now the situation is just extraordinary, where the Turkish market is just throwing up these deals where one company that I'll mention, and by the way, I should also point out, all of these details are available at talascapital.com. Masoud and I have been writing letters for these 5 years. There's maybe 20 letters up there. And they talk about the different investments that we've made. In many situations, you need a Turkish tax ID, but if you buy these individually. But we are pretty transparent about how this portfolio makeup looks. And there are companies like Şişecam. We've been meeting with management for years, and they're a global glass manufacturer. They're one of the top glass manufacturers in the world, top 10 glass manufacturers in the world. And they have these sort of soda ash composites, even as far away as Wyoming in America. They're selling, they have 4 different sort of sectors of glass that they operate in, from glass paneling to sort of more practical, like bottling type materials. And they're trading for 5-6 times earnings, and they're selling all of this material in like dollars and euros all over the world. And their costs are based in lira, and they're buying back a massive amount of stock, and their earnings are growing at double-digit rates. Their business is a very sustainable, high-quality business. Management is very well educated. They're making very shrewd steps. In fact, it's a big deal to be buying back shares in places like Turkey. For a lot of the past, there's a resistance to share buybacks. So the firms are now starting to buy back, things like Coach Holdings doing big buybacks, Şişecam doing big buybacks. These kind of companies become very attractive to us. And so, your followers can go and look up some of these firms, and they can read through the letters and see that there are just these extraordinary opportunities where globally maybe it would trade for 18 or 20 times earnings, but because it's on the Borsa exchange, it's trading for 6. Earnings grow, they're buying back stock. Companies like this can triple very, very quickly. I think you're familiar with how quickly in a developing market, how quickly these swings can happen. So what can happen is an early election's called, and suddenly that happens very quickly. The outcome the outcome will not impact the thesis. The thesis is that after the election, orthodox economic policy get put into play, and then foreign funds will come quickly back into Turkey, and the markets will rise, and our high-quality businesses will rise much further and faster than the rest of the market. And I think we're well positioned for that right now.
No, makes perfect sense, Matthew. So can I assume that, before this orthodox economic policy, comes into play in Turkey, it's still highly mispriced at this point in time, and would Yeah. So it's a good time for acquisition, right?
It is. It is such a good time. There are a few complications when you go into Turkey, like you need the tax IDs and things like that. We have people that use our funds for this purpose to get around needing things like that. But individuals can go, a family office or whatnot could go and acquire an entire business right now. It is, I think, the least expensive market in the world, perhaps with the, realistically, it's the least expensive market that's investable. You might have some Russian securities now that are very mispriced somewhere, but I don't think it's worth looking at those. But this is, and Masoud has laid out this chart in the letter where he goes through developing countries from like Indonesia across the board into Pakistan, and it's just looking at earnings multiples. And Turkey is the lowest in the world at this moment in time. And it's quite strange because if you look at the high quality businesses we're looking at, it's so clear that these are worth multiples of what they're trading for right now. So we have, these energy companies that are basically supplying, 80% of their capacity, like Orlu Energy, is just servicing the local demand. And then Turkey is still importing external energy. So there's not going to be, they're always going to sell the refined oil in all of the cases each year. And they're priced in they have global prices. It's not priced in lira or something. And so, but their costs are in lira. So it becomes quite strange when these are paying like 10% dividends and trading for 6 times earnings. It's a unique situation. We absolutely cannot find that for Peterson Capital in the U.S. markets. We use a little Peterson Capital through Talas, which we built. We do get access to the Turkish markets. So we do have about 5% of Peterson is over in Turkey. But these opportunities do not exist in the developed world. You would not find this level of mispricing. And of course, along with this mispricing, in Turkey, you get more volatility. Okay, so there's a little more uncertainty. But I do think if you're able to stomach those challenges and you're able to understand the underlying businesses, the Talas, the Turkish opportunities are quite remarkable. Many of the firms can double and triple or more in a short period of time.
Yeah, I think I can relate to that quite well, though I haven't been studying Turkey that deeply. But I think I can understand the phenomena being in a category of market we belong. So and we generally look at. So I have quite a bit of questions on this, but I think today it's not a very wise thing to do to carry on all those follow-ups. So rather we go on to the planned question to the next that we have. And definitely, Matthew, we'll come back to this point in the next show or maybe on a separate meeting, if you may allow.
Absolutely. Yes, no problem at all.
Now, Talas Capital, your value fund in Turkiye, charges no management fees, and you have a perfect alignment of interest with your clients where you only charge a performance fee on the money you have made for your clients, which is fantastic and very rare. With respect to how much you're willing to disclose, Matt, for people interested to know more about the investment opportunities in Turkiye, and you've already shared an example, but could you share a real-life example of an investment and lay out a brief thesis behind that allocation?
Yeah, sure. Yes, that's a good question. The beginning of the question, you're asking a little bit about the operational nature of the fund and I think funds in general. So yes, for both funds, we have a zero management fee share class. And for Peterson, it's for $2 million and up, and we have an exception class. And for Talas, it's all capital actually has a zero management fee. And this is basically modeled after the original Buffett partnership. So Charlie's mentioned at a number of meetings and publicly that this is the fairest business model. This is the fairest way to run a fund where you have a clear alignment of interest. We do not get paid unless we have great returns. And so you can look quite quickly at the Talas returns and you'll recognize we're not earning anything when we have flat performance for 5 years. And so the reason it's so rare is most fund managers don't have the capacity and are unwilling to just operate in this manner. But this is the right way to operate and exist. So unless we make and we have hurdle rates as well. So we have a 5% hurdle rate. We never charge on that each and every year. And we have high watermarks. So if we go down, we cannot double dip and charge on the way back up. We have to be hitting new highs to be charging. So we actually put a lot of obstacles in our path to earn any income. But at the same time, we expect that we will perform quite well over the long period of time, and then we will all do well together. So this is the fairest way to run a fund. There are many funds out there that charge a 2 and 20 sort of allocation, and they're basically charging 2% for managing the portfolio, and they're charging 20% of anything they make return-wise. And in those cases, the fund manager ends up with all the money, and the investor ends up with a lot less of the money. We want to win when our investors win. We want to, we are close with all of our partners, and we want to see them succeed. We want to see their wealth growing, and we want to be moving in the same direction together. So let's see. I mentioned Shishijim. You asked for these examples, and I'll point out it's rare. We find we need to talk a little bit about the Talas portfolio, but it's not always healthy psychologically to do so. So there are biases you introduce when you go out publicly with these positions, but I do want to point out two things. First is that on talascapital.com, we summarize these businesses in an investment case in each of our reports. So you can actually follow along with the current investment portfolio. Another thing I will mention that we're doing with Talas is they tend to fill up, and they are first and foremost for our investors. But we do these Talas tours where we arrange a tour with a nice Mercedes van. We have it's a very nice event, and we go and we visit 6 or 7 businesses over about 3 days throughout Istanbul, and these tours are really incredible. So we just did one in January.
Very interesting.
We were at places like Anadolu Hayat, which is one of the larger insurance brokers in Turkey. We went to the Coca-Cola bottling company. In the past, we've gone to places like Arçelik and watched them, automate the building of washers and dryers and what they call white goods, and ship them all over Europe and even Asia. So these tours are quite interesting, and for me, it's like a highlight of my year. So if any of your viewers would like to join the tour, they just need to reach out to myself and Masoud, and we can fill in them in on some of these details. The space available, we can't fill these boardrooms with more than a dozen or maybe even 10 people. So first and foremost, it goes to the slots go to our partners and our investors. But we do welcome people on those tours. So what is the investment thesis of some of these firms? So look, why don't we just look at Shishijim again for a moment. So global glass manufacturer, one of the top 10 in the world. They're satisfying all these very consistent demands and growing demands. So things like buildings and architecture are moving and shifting as technology allows, they're shifting toward more glass and less, in a way, cement and steel. So people like big, bright buildings. And so that trend is moving in that direction. All sorts of bottling and manufacturing facilities exist, and demand for those products, like if demand for Coca-Cola is increasing, demand for all of those types of goods is also increasing. So we see these trends moving in the right direction in all of the categories that they're operating, and yet they're selling for like this very low 5 or 6 times earnings and just outrageous, bringing in enormous amounts of cash flow. Now, in the past, they haven't always been able to buy back their shares because things like, frankly, in Turkey, having met with many of these managements over years, many are concerned about the impression of stock price manipulation through their buybacks, which to us doesn't make sense, because buybacks are one of the tools that management can use to create or destroy value within the business. And it's not manipulative. If Berkshire is selling for a price close to 1.2 times book or some internal multiple of earnings where they deem it's undervalued, it's the best use of their capital. And the same is true right now for companies like Şişecam. And so when Şişecam or even Coach Holdings, Coach, just such an obvious conglomerate, they start issuing these massive buybacks, a lot of times issuing really high and sustainable dividends. These become very attractive opportunities for us. So Şişecam has a global market. It's just trading on a local firm. Many of its costs are local in a depreciating currency, where its revenues are in the relatively appreciating currency. So hard currency revenue and appreciating currency cost, buybacks in place, low debt, growing trends in the space, and selling for 6 times earnings. It's like, what's not to like? This company, you could, it would be very difficult to disrupt the movement of Şişecam. It's a global business. It's not a local business. So even if there was something terrible that was happening in the local space in Turkey, Şişecam would continue to operate around the world. And ultimately, the price should reflect that. And it's much more reasonable to have closer to 10 times earnings, and earnings is growing at double-digit rates of return. So, push this out 3 or 4 years. Oh, and share count is declining. Push this out 3 or 4 years, and I think you can have a very, very extraordinary return situation. We may have some years that it's going up 50 or more percent, maybe more in a year.
So much to learn, because I think it's very difficult, as you just mentioned, this 13F in US, but the amount of information we got about Turkey and how you are really thinking about these companies and the tour, especially the buyback manipulation. We are so familiar with these sort of mindsets. It's very interesting, and we are completely forbidden here.
Things are changing. So, sorry to interrupt you. I want to point something out. Okay, in these developing markets, some of your viewers may be aware of this. In the Western world, developed markets, I don't think people understand this quite as clearly. There are many aspects of the mentality that is somewhat flawed. So, for example, but the point is that these trends, if they're moving in the right direction, will open up and change the dynamics of how these markets work. So, for example, in a developing world, we all want to see management owning a large share of the company that they're managing because it aligns interest. If we see that Warren Buffett owns 30% of Berkshire Hathaway, we're very pleased with that, because it means that we're on the same side as Warren Buffett in this transaction. In Turkey,
Absolutely.
it's very uncommon for executives to own shares of their stock. It's viewed as sort of there could be manipulation going on, there's insider dealing going on. When does the management decide to buy their shares? They know more than everybody else, and so it's an unfair advantage. Whereas we look to that as a signal in developing markets because they know more and they're buying their own stock. We like to see that. In Turkey, that mentality is slowly shifting. We would love to see where, they're issuing shares to the employees, so everybody is incentivized to make every aspect of the company better, safer, not have fraud activities going on within the business because everybody's an owner of the business. You're less likely to be incentivized to do something unethical if you own a piece of the business that you're involved with. And so we like these trends that are happening, new buyback trends that we see, some executive ownership trends that we see. We met with, and we had to ring the bell at the Bursa Stock Exchange during one of the past tours. And when we were talking with the executives there, they had gone on a national campaign, city by city, to run and inform everyone of the differences of holding periods and investment approaches between the local investor and a foreign investor. And they talked about how foreign investors think long-term. Foreign investors are valuing the business, dividing by the shares outstanding and seeing if it's above or below the actual intrinsic value of what they own. And the locals are treating it much more like a casino. And it's very hard. Even they emphasize it's so hard to break through that mentality. We are close with all these people. We were in Turkey, as I mentioned, in January, and I was talking to this very bright engineer about his own portfolio. This is separate from Talas, and he said, what should I do? I said, you could buy Coach and hold Coach for many years, Coach Holdings. Wide conglomerate. You don't need to hear from me afterward. You just hold on to it. And I ran into him about 3 days later, maybe it was 1 week later, and he was so happy. And he said, I already made 6%. I said, that's wonderful. That's not anything. Just wait on it. He said, what do you mean? I already sold it. And so this is the mentality. It's like I make 5% and I exit the market. Whereas foreign mentality is I'm looking for this to go up 5x and it will just be beginning. But these trends in mentality are happening in Turkey. So the exchange is trying to educate locals to invest better. Businesses are starting to lean toward maybe stock ownership being a good idea. Buybacks are starting to happen in small areas. But because of the current environment, regime, political environment, the region in the world, it is these opportunities. There's huge opportunities they're trading for, in many cases, 3 times earnings, 4 times earnings. Great businesses trading for 5 times earnings. It's a remarkable opportunity.
True, and I can totally relate to you when you're saying all of this. And as we started with this thought that we are doing this WFA, this Wise Folks Almanac podcast. One of the prime reason is to educate people on this shift of mind that needs to take place when a country's space is actually moving from one place to another, especially the spot frontier markets like ours. And that is so much resonating to your Turkey experience. I'm really glad that we are doing the right thing, possibly.
I'm sure a lot of people will be interested to know more about Talas and Peterson Capital. We will make sure to put the links on our show note and in the description box below. You have a brilliant way of building and sizing your investment position with options. And we've got to admit that we just cloned that idea from you. Matthew, the experienced investment professionals watching the show right now would like to know, how do you deal with options? could you describe your process of selling puts in acquiring assets and covered calls to sell egregiously valued stocks through the Chicago Board Exchange with a hypothetical example? And you also have said that it is possible to take advantage of Alibaba shares with the same process. Could you lay that out for the audience?
Yeah, Ryan, absolutely. That's a great question. And so we're sort of switching now to focus on the activities of Peterson Capital Management and some of the strategies we use to acquire the great businesses that we're looking to build into the portfolio. There is a lot of background information available online. So I encourage folks to go out. They can look at our YouTube channel or even on our website, petersonfunds.com, or Peterson Capital Management can be searched on YouTube. And you'll find some of the core fundamentals behind this strategy. But I will explain them briefly here. Through traditional markets, New York Stock Exchange, et cetera, most professionals and retail investors use those methods to buy stock as they have for decades and even centuries. So they'll use a market or limit order to acquire the shares. For almost a couple of decades now, I have only been buying shares through this alternative method where we call it structured value. And we're basically using option contracts for their non-traditional use. So we are writing a cash secured put contract as a tool to obtain the equity. What that means is if you have a hypothetical stock that's saying shares say selling for $10 a share, and you're interested in buying them, instead of buying them through the New York Stock Exchange, you could write a commitment and sell it to a counterparty. Basically say, I'll buy your shares for $10 a share anytime over the next 6 months. And you have to pay us $2 for our commitment. We're ultimately insuring your shares, but we know quite a bit about your shares, by the way. So we know they're worth quite a bit more. So we're happy to collect your $2, hold our $8, and be prepared to buy your shares for $10 should you want to sell them to us for the life of the contract over the next 6 months. And it's ultimately a binomial outcome. If the market price of the stock is below what we've offered to buy them for, when the contract expires, the counterpart will sell us their stock. So in that scenario, they will put the shares to us. We will pay them $10, $2 of which was already their premium. And our net cash outflow to acquire the shares is $8 a share. So instead of buying them in the New York Stock Exchange for say 10 or maybe 9, we're moving in for 8 6 months later. Alternatively, if the market price is above the strike price of our put, the contract expires. And when the contract expires, nothing happens. It's over. We keep the premium that they paid, and the relationship ceases to exist. So we now have $2 that we've made on an $8 collateral over 6 months. So that internally to us looks like it's 25% and is a 25% gain in our capital. We've earned $2 on $8. We never own the stock, and this goes out for 6 months. And if we wish, we could sell a new contract. So this is the very standard practice we use to move into a new position. And also, I will add, we exit in the exact opposite manner. So after years and years, hopefully, of holding and compounding and all this growth, the firm is at and exceeding its intrinsic value, and it is time for an exit. If the shares have appreciated to say $80 per share, so they were originally at 100, and now they've appreciated to $800 per share. We will look to exit. So we will write a covered call. We will sell a call through the Chicago Board of Exchange that allows somebody else to buy our stock from us. And again, they pay us for that privilege. So as the shares run up, people are getting a little euphoric. Maybe they're willing to pay a little bit more for the shares, for the call option at this point that we are now selling. So as we go in, we could sell in New York Stock Exchange for say $800 a share. But instead, we go into the market, we say, oh, if we are willing to wait for another 6 months, the shares are selling for 800, maybe we could commit to selling it for 850 and receive a $50 premium. And then again, we have a binomial outcome. If the shares are above, if the market price of the stock is above 850, they will get called away from us. And we will have sold for 900, 850 plus the 50 in premium. If they don't make 850, contract's over, we keep the 50, we still have the shares, maybe they're now still at 825, we can go ahead and sell another contract. So we can continue writing these calls until the transaction is complete and we've exited. Now, what does that mean? That means the normal investor would buy these shares for 100 and then sell for 800. So, they would make 8 times their money, kind of a 700% gain. But we've constructed a way using the structured value approach to buy for 80 and sell for 900. Now, what that means is we're now making we're making 9 times our money, let's say for simplified math, instead of making sort of 8 times our money. In fact, simplified math, I'm doing too much in my head. Let me just take a step back, guys. So instead, in the alternative situation, we are purchasing these for $80 a share, and then we're selling them for $900 per share. So in this case, we're clearly getting like 11 times plus our return instead of receiving only 8 times our money. And if this, say, takes a decade to unfold, you can work out the IRRs. If you make 11 times instead of 8 times over the same time frame, you end up with annualized IRR that greatly outperform your traditional professional investor, retail investor. So this approach is very advantageous. It directly impacts your IRR. You are literally getting into great positions for a lower amount of capital. You're lowering the denominator when you're calculating your returns. You're lowering the cost of your ultimate exit. And so it's so advantageous that even in a personal account, I would only do this. There's no desire for me to just buy stock in what I look at as a very old-fashioned traditional manner. So I know I went on for a long time with that example, and folks can go out and look at a lot of our material online. We've done some extended interviews specifically on that topic. But you asked directly about Baba, and Baba's a very interesting situation. Alibaba looks to it's becoming one of the global cloud players because of some things happening in China and in the tech space. So tech is kind of down, China's kind of down. They're actually quite reasonably priced, seem quite reasonably priced. And if you look up a bunch of different value investing 13Fs, you'll see Baba is appearing on quite a few. It's appearing in a lot of the portfolios of great fund managers. So Baba is very interesting. How could you go about applying this to Baba? So I think Baba is around $100 per share. I'm talking about the US ADR now is around $100 per share. And again, you could go, if the exact same scenario plays out, you can go and buy these. Instead of buying these for $100 a share through the traditional markets, you just simply write a put contract. And if you put that strike at 100, and your strike could vary, you could have a strike of 110 or a strike of 90. But if you put your strike at 100, you could possibly go out 6 months or so and ask for a price of $20. These contracts are very volatile, so you can put your price far outside of a bid-ask range that's available today. And over the next few days or week, or maybe month, there will be some trigger that moves the prices up, and you'll be waiting there, and somebody will buy your puts from you. Somebody will pay you $20 to buy Baba for, say, $100. And then the same scenario plays out. It's a binomial outcome. Either you make $20 on your 80 in collateral and you get 25% over the time period prior to expiration, or the alternative is that the shares decline a little bit and your counterpart puts them to you, which temporarily could make a slight decline. The shares have to go down, but in the long run, that's what you want to have. You want the shares. And we only do this when we want the shares. So we use this as a tool to buy the shares. And with Baba, you can use it right now in a very advantageous way. I think Charlie Munger started buying Baba around $200 per the ADRs in his daily journal company. Today, through what I've just explained, there's a really great way to get in for 80. So you're buying the same exact asset that Munger bought for a 60% discount to what Charlie Munger paid. So yeah, it's a pretty attractive situation.
No, absolutely, and it's a great insight, Matthew. While you're talking about this Alibaba stock, and also how you structured options to actually, but not going rather not going or leaving the purview of creating value. You utilized it as a tool to get a great discount while protecting the downside, and it's still making an upside if that assumption doesn't work out. So this methodology is I think a great thing to study, though we possibly don't have this tool to apply to our market, but it's a great thing to learn, because I'm sure this will come sooner or later to these marketplaces as well in future. So
that's right.
and nothing will stop us as well to access those markets if our capital restrictions goes out. So it's a great thing to learn, and we can always take the advantage as the fund managers of our place. So
and I'm so pleased that you're doing this. Your viewers, I think, will learn quite a bit if they try to write one of these contracts on their own. The only thing, there's a few things to be aware of, but one contract represents 100 shares. And so if you're looking at a $100 Baba ADR as an example, a single put has a notional then of 10,000 US dollars. So you need to have some sufficient size if you're building out a diversified portfolio and you have probably more than one of these contracts. You might have diversified strike prices, expiration dates, and all sorts of different mannerisms. But even to go out and write one and watch how it plays out will become a very great learning experience for a lot of your viewers.
It's just very smart, Matt, and we love it. We should perhaps shift our gears towards Seritage a little bit right now. In your recent video with Tom, you shared the possibility of Seritage trading at around $5 a share. And lo and behold, your prediction came absolutely true. Not only that, but at the time of recording, it is trading at $12 a share. Eddie Lampert, the former chair of SRG, also changed his LP shares into Class A commons and voted to sell all of the company's assets, distribute the net proceeds to the shareholders, and dissolve the company. Matthew, the investment experts watching the show would like to know how you've used options in your Seritage investment case.
That is an excellent question. And again, I talked briefly about how I want to preface this by saying it's unusual for us to talk so openly about these current holdings. There are commitment and consistency biases, etc. However, this one has been so uniquely controversial that we have been a little more public about our views on this. In fact, there's quite a bit of short interest. There's quite a few people who are claiming this is sort of a bankrupt company. And, we are very aware and watching this scenario. Our views differ considerably, as I've explained. So what is happening today with Seritage is actually different than what was happening even during the interview with Tom. So basically, if I take a step back and look at Seritage, as many reviewers know, is this ex-real estate spinoff from Sears Properties. And to get a full understanding of what Seritage is worth, we had to go through the original 212 properties. These are large, complex, sort of commercial type buildings, mall, retail centers, sometimes standalone units with multiple activities taking place on these properties. So they could be overparked, they could have development plans, they could have new entitlements in play. And we had to value every single one. That doesn't seem maybe too onerous, but if you spend a lot of time with a single property, you start to really become familiar, and there's only 212. So for us, it doesn't seem onerous, but I think, it can take someone quite a while. We've gone through every property. We understand quite clearly that there's about 3 to 4 billion in value within these properties, depending on a certain amount of factors. And they have about 1.5 billion, and that's a pretty conservative number. They have 1.5 billion in debt, mostly to Berkshire Hathaway, and then about 77 billion of these preferred shares. And there's 55 million shares of stock outstanding. So you just divide, the value of the properties by the price, and maybe filter in some factors for probabilistic risk scenarios. You get a highly positive scenario where the shares should be trading for sort of $25, $26, $27 a share, and they're sitting around at 10. So, this is a great value type opportunity. And what's happened since the interview with Tom is that management has come out. Eddie Lampert's converted all his shares, et cetera. I think maybe that was just prior. And they've come out and they said, we are going to liquidate the entire business. So they have brought in new CFO, John Garelli, who has experience in these full liquidations, and he creates a lot of shareholder value when he does these liquidations. And they're trying to section off individual groups of properties and individual portfolios, and they're just going to sell this company. So this will not be it will be a little bit of a roller coaster. There will be some properties that maybe were expected to receive a certain price, they get a lower price. There may be delays, there may be trouble, but ultimately I expect this will be mostly successful. They are just going to liquidate properties we've seen the value of properties run up so much in America over the last 2 years. We've had interest rates low, we've put money out everywhere, and there's inflation going on. These properties have quite a bit of value, and some of them are extraordinary properties. They have these premier mixed-use properties in places like Santa Monica, places in Miami. These buildings are really valuable. And they have others that are not valuable. That's okay as well. So as they begin this liquidation process, management has, I believe, sandbagged the number, but they've announced clearly that I think $18.50 to $29 a share is what they expect to hand out in cash over the next sort of 36 months. Maybe it's a little delayed. Maybe it takes 48 months. Okay. So what I was suggesting with Tom, and this still exists right now, it's quite remarkable. We have a full position. We have it's actually quite a large position. I will share with you that, when it was dipping down to, you mentioned the 5 price, we were being put a lot of shares because we were selling puts and they were being exercised. We were being put shares. So we had about a 15% position, and that's now doubled. So it's, maybe it's 30% of the portfolio right now. And that's a large position. And we actually expect it to naturally all become cash. So it's a beautiful holding. It will all slowly become cash. We'll receive distributions and payments until this liquidates. And from this point, we expect maybe we get about 150% or more from our current holdings. So it's quite an interesting scenario. Now, let me explain how fantastic this is with the put and call and the puts that I just mentioned. So Black-Scholes is the common model used to price these, and the factors in Black-Scholes are very quantitative. there's no qualitative aspect to understanding that the CFO just switched from essentially a CPA accountant type to a very active handheld liquidator. So there's nothing in the Black-Scholes that asks that sort of question. Black-Scholes just looks at volatility, and the price of options are highly correlated with the volatility of those shares. And because there's so much uncertainty, and uncertainty and risk are two distinct things. Uncertainty is maybe an unknown outcome, but the outcome in either scenario could be okay. Risk is like the risk of a permanent loss of capital. So there's a lot of uncertainty with Seritage. We don't know, are they going to be, we don't know how successful the liquidation is ultimately going to become, but we do know that the odds are in their favor of being quite successful. We don't know if Eddie Lampert tries to make bids for certain properties. We don't know what's going to happen exactly. There's a lot of uncertainty around it, but we do know that the outcome from John is probably going to be very valuable to the shareholder. And so as the shares are now volatile, trading at 12, you could actually go out and write about maybe there are 5-month contracts available out until about January of next year. And if the shares are trading for 12, you might be able to pick up $2 or more in premium to buy just right now at that price. And that's so attractive because not only could you put in a price to buy it at 12, maybe you could also, during a dip, put in a price to buy it at 10 and ask for an outrageous price. You might even be awarded $2 with a $10 strike if the price declines for a little bit. In that scenario, you're going to be in a position where you're making sort of a 25% premium over a 5-month period. It sort of becomes like 60 or 70% annualized. And it's just an incredible return, and you might not even be put the shares. What's interesting in a situation that, and I'll actually talk a little bit about this. So there's all sorts of things that happen when you actually put this into practice. In theory, nobody would exercise their option before expiration date because they've paid for time. Theta is one of the factors that they're paying for. So if you've paid for time, you wouldn't actually exercise before the time expires because you could just let it play out and see what the end looks like. So we write these contracts, but market participants aren't always rational. Some of them are levered. Some of them have other mandates taking place. And so when shares come crashing down, we get put our shares early. People get scared. They want out of the position. Maybe there's leverage. So we have these outstanding contracts that maybe didn't expire until January with a strike of, say, 10. And as shares dip to 6, because everybody's fearful, one, our conviction, because we've done the analysis, we understand that they have cash in the statements. We understand that there's not a liquidity issue at the moment. People are afraid of a liquidity event happening next July, which is a very unlikely scenario because there will simply be a restructuring to Berkshire if at all necessary. So there's not really a liquidity issue, but everybody's afraid of a liquidity issue. And as the shares dip down, we were put a lot of the shares affiliated with the put contracts we have sold, which is exactly what we want. It feels a little uncomfortable because prices are falling, but we're being put shares. And then, of course, they've now rebounded over the last sort of month and a half. And we're sitting here with shares that we bought for $6, $7, $8, $9, and they're trading for 12. And we expect that we'll be given sort of 20 to 25 or more dollars in cash for the shares that we just recently purchased for $6 or $7 or $8. So even today, the opportunity still exists. We have a totally full position. If we had more cash, we would be selling more puts on Seritage. It is a very unique situation where a company is going to go to full liquidation, bring us back to cash. We'll be able to reallocate that capital in 3 or 4 years. But right now, we're looking at a very clear sort of triple on a very secure position that's basically owns a whole bunch of U.S.-based real estate and very attractive real estate. So we're very happy with Seritage's position. It's volatile. It's controversial. People tweet at me quite often that my theory is wrong, but I think the future will show us. And it looks like a very attractive situation if you utilize the sale of a put as a tool to buy the stock. You can sort of be picking up 30, 40% annualized on those IRRs right now.
That's very interesting, and actually, I believe that we actually need to expand on this and maybe make actually a specialized episode on kind of a training on this and how to map this out on absolutely like a masterclass. So. So Matthew, moving on, now we don't really want to hold you for so long, Matthew, and we're extremely happy that we had you and shared this knowledge. But our audience surely would love to know, not only our audience, us as well, would love to know more. And we, have got to have you back on the show in the future. So why don't you tell our audience how to follow you, your funds, and other publications, and how to get hold of onto your wisdom and knowledge?
Definitely. I think following us on Twitter and YouTube, that's where current things are usually being posted, and then our website is packed with information. So petersonfunds.com. You can find all the details. You can follow us on Twitter. And Matt Peterson CFA, I think, is the Twitter handle. You should be able to find me. You can email me directly if you have questions. We're actually bringing in capital to the fund on a regular basis and with quarterly commitment dates. So matthew.peterson.petersonfunds.com. Petersonfunds.com is a great way to reach out. You can also reach out to Masoud. Masoud is running the Turkish portfolio. me@talascapital.com and talascapital.com is that website, and you'll see all sorts of information available there. So there's quite a lot to look into for any of your viewers.
Thank you all for joining us today. And this show is sponsored by Air Capital. For more details and updates, please visit www.ar.capital. I'd also like to announce that our pre-launch annual report is out for your weekend's reading. The links will be provided on the description box below. If you like today's episode, then hit like, subscribe, and press the bell icon. And don't forget to share this video with your friends. Follow us on Facebook, Twitter, LinkedIn. And Matthew, obviously, we've got to have you on the show again. Yeah, until the next time. Thank you.
Thank you very much, Riyan. Thank you, Ahmed.
Yeah, thank you, Matthew. Until the next time.